Understanding reverse equity loans. A guide for investors at every stage. Reverse equity loans, often referred to as reverse mortgages, offer a unique financial solution for homeowners, especially seniors. These loans can be a valuable tool for various financial needs, but they come with specific benefits and risks. This article will explain the basics of reverse equity loans, outline the pros and cons for different types of investors, and help you determine which option might be best based on your financial goals and stage of life. What is a reverse equity loan? A reverse equity loan allows homeowners, typically aged 62 or older, to convert a portion of their home's equity into cash. Unlike a traditional mortgage, where you make monthly payments to the lender, a reverse equity loan provides funds to the homeowner, which are repaid when the homeowner sells the home, moves out, or passes away. Types of reverse equity loans. Home Equity Conversion Mortgage, HECM, Proprietary Reverse Mortgages, Single-Purpose Reverse Mortgages. 1. Home Equity Conversion Mortgage, HECM. Overview. HECM is the most common type of reverse mortgage and is backed by the Federal Housing Administration, FHA. Pros. Guaranteed funds. FHA insurance guarantees that you will receive the funds you're eligible for. Flexible payout options. Choose from lump sums, monthly payments, or a line of credit. No monthly payments. No need for monthly mortgage payments. The loan balance increases over time. Cons. Accruing interest. The amount owed grows over time as interest and fees accumulate. Loan costs. High upfront costs including origination fees, closing costs, and insurance premiums. Reduced home equity. Less equity for you or your heirs as the loan balance increases. Best for new investors. Generally not suitable for new investors as it's designed for homeowners looking to access their home's equity. Experienced investors. Useful if you own a home and are considering converting some equity into cash for investment purposes. Investors aiming for early retirement. Not ideal for early retirement plans but can be part of a broader strategy if you're close to retirement and need funds. Investors near retirement. Can provide needed cash for expenses or investments, however, it will reduce the home's value for inheritance. 2. Proprietary reverse mortgages. Overview. These are private reverse mortgages not insured by the FHA, often offered by private lenders. Pros. Higher loan limits, may offer larger loan amounts than HECM. More flexible terms. Lenders might offer different terms and conditions. Cons. Less regulation. Fewer consumer protections compared to HECM. Higher costs. Often have higher fees and costs. Best for new investors. Not typically relevant for new investors unless you're a homeowner looking for a high loan amount. Experienced investors. Can be considered if you own a high-value home and need a larger loan. Investors aiming for early retirement. May be useful for accessing larger amounts of equity for investment or early retirement plans. Investors near retirement. Useful for those who need a substantial amount of cash and can manage higher costs. 3. Single-purpose reverse mortgages. Overview. These are reverse mortgages for a specific, approved purpose such as home repairs or property taxes. Pros. Lower costs. Generally lower fees and costs compared to HECM and proprietary reverse mortgages. Specific use. Funds are used for a specific purpose, which can be advantageous for managing home-related expenses. Cons. Restricted use. Funds must be used for the specified purpose. Lower loan amounts. Typically offer smaller amounts compared to other reverse mortgages. Best for new investors. Generally not applicable unless for a specific home-related expense. Experienced investors. Rarely used for investment purposes. Investors aiming for early retirement. Not ideal for early retirement strategies. Investors near retirement. Useful for covering specific home expenses like repairs or taxes. How to choose the right option. For new investors. Reverse equity loans are generally not suitable for new investors unless you are a homeowner who needs immediate cash. Focus on traditional investment loans or savings options instead. For experienced investors. Consider HECM if you want to access home equity to fund investment opportunities or manage large expenses. If you need a larger loan amount and can manage higher costs, a proprietary reverse mortgage might be a good option. For investors aiming for early retirement, HECM loans can provide funds if used strategically, but be cautious of the long-term implications. Evaluate if the benefits outweigh the risks of reduced home equity and increased costs. For investors near retirement, a HECM or proprietary reverse mortgage can be beneficial for managing retirement expenses or making strategic investments. Ensure you understand how it will affect your home's equity and inheritance. Single-purpose reverse mortgages can be useful for covering specific expenses like home repairs or taxes. Conclusion: reverse equity loans can be a powerful financial tool but come with significant considerations. Understanding the different types of reverse mortgages and their implications for various stages of life and investment goals can help you make an informed decision. New investors: focus on traditional investment financing options. Experienced investors: consider HECM or proprietary reverse mortgages for accessing home equity. Investors aiming for early retirement: use reverse equity loans cautiously for short-term needs or strategic investments. Investors near retirement: evaluate reverse equity loans for managing retirement funds, but be aware of the long-term effects on home equity and inheritance. By assessing these options in the context of your current financial situation and future goals, you can better determine if a reverse equity loan is right for you.